Market returns during US election years. Today, I want to talk about what the market has done during an election year and also in the subsequent year to follow. There's three key points to keep in mind. It's difficult to identify any return patterns or similarities during election years. But on average, market returns have been positive both in election years and in the subsequent year to follow. Market expectations associated with election outcomes, so what they think might happen because of the election, most of the time is already embedded in the stock prices that you're seeing today. And I know what a lot of you may be thinking is that this time it's different. So it doesn't really matter what happened in the past. With COVID-19 going on and tax changes that could be proposed, that this election is more important than ever and could have the most drastic outcomes on the stock market. One thing to keep in mind, we've seen similar crises or recessions in the past during these election years. And like it says, on average, returns have been positive in the year of the election and also in the year that has followed. So looking at what the returns have done during and after US election years. So the election in 2016 between President Trump and Hillary Clinton, as you could see, during that election year, the market averaged 12%. And in the subsequent year to follow, the market return for that year was 21.87%. See a very similar trend back in 2012 when President Obama ran against Mitt Romney. And as you can see there, during the election year, the average return on the market was about 15%. And in the year to follow the election, the average return on the market was around 32%. So there is a pretty consistent pattern from what we see both during an election year and in the year to follow. And all throughout history, the return has actually been a little bit higher during an election year than in the subsequent year to follow. So now we'll take a quick look at average annualized returns during US presidential terms. So the average return for a US presidential term is 10.3%. And as you can see here, the market returns for President Trump currently on average are about 15.27%. President Obama during his two terms came in around 14.9% and around 14.3%. This chart goes over it a little more clearly. The only thing that has been updated is the market returns are showing through March of 2020 for President Trump. So the average return under President Obama was 16%. For Trump, it was 6.2%. President George W. Bush, obviously a lot that went on during his terms as president. He averaged a negative 4.4%. President Clinton was around 17.6%. Ronald Reagan, who a lot of people still deem as one of the most popular presidents, got about a 15.8% average return. So what does this mean for bonds? So one thing to keep in mind, as you could see, there was a wide variety of different returns, both during an election year and in the year to follow for stocks. However, if you look at what bond prices have done, they've stayed pretty consistent throughout history. So the average return during a US election year for bonds is 7.6%. And in the year subsequent to the election, it's 7.3%. And if you look closely here, the annualized returns during a US presidential term for bonds, as you can see, under the average return is still about 7.1%. Under Trump, the average bond return is about 4%. Under President Obama's second term, it was about 1.7%. During his first term, it was about 6.2%. So if you're looking for something with a little more safety, if you're looking for an investment that may not be as volatile, then looking at investing in US bonds or the US aggregate bond index may be a good option if you're looking to invest during or around the election. Lastly, the most important thing to keep in mind is that markets have always rewarded long-term investors. So Does not really matter who is in office. If you look at the history of the stock market, it has continued to climb, and it's continued to climb again this year. The S&P is up around 8% as of today, and as you can see, the market has hit several new all-time highs this year, even during a recession. So try to avoid any drastic moves, try to avoid timing the market, try to avoid going to all cash and thinking you could jump back into the market. The most important part is to stay invested and to not panic.